Hello, everyone. I'm Erin Hussein, and I am the Associate Director for Alumni Relations for GSAS. As GSAS alumni, you are part of an alumni association that includes over 44,000 alumni worldwide. After commencement a week from today, that number will grow to over 46,000 as we welcome 1,600 graduates. I'm so glad to be connecting with all of you through this format today. I am so pleased to introduce GSAS Conversations in webinar form. We have reimagined the long-standing GSAS Conversation series as a webinar to engage and connect with all of you during this unprecedented time. This series of special virtual talks for friends and alumni of GSAS feature alumni scholars and practitioners sharing their perspectives on conversations arising from the pandemic. We invite our friends and alumni to join us now through the month of June for quick deep dives into aspects of the crisis, thought-provoking examinations of issues at the core of humanity, and much-needed distractions. Thank you for joining us today for today's stock market versus infamous bear markets. We are excited to welcome David M. Blitzer, who earned the PhD in economics in 1978. He is the former chairman of the S&P Dow Jones Index Committee. Over his 39-year career at Standard & Poor's, including 30 years as the chairman of S&P Dow Jones Index Committee, which is the committee that oversees the S&P 500 stock index, David had a unique vantage point for the bear markets of 1987, 1999 to 2000, and 2008. Today, David will share his thoughts on how the current downturn compares with those bear markets of the past and whether they may provide hints as to the trajectory of recovery. A few notes before we begin. Although you will be muted through the presentation, you will be able to ask questions through the chat function. We also have a few questions that were already submitted. We will ask David as many of your questions as time allows. And lastly, please note that anything you hear during the presentation today is an opinion and is for information purposes only. It is not intended to be investment advice. You should seek a duly licensed professional for investment advice. With that, I introduce David Blitzer.
Thank you, and good morning, Erin. We've seen in the last few weeks, in a couple of months, a lot of turmoil and gyrations in the stock market. And we're going to look at those and we'll compare the bear markets in the past and see what that tells us about what's happened and maybe gives us some ways to think about what's coming forward. Just to give you a sense of the recent gyrations, from February 19th, when the market hit an all-time high, till March 23rd, it dropped about a third, which is pretty fast. In fact, as we'll see in a little bit, it was the fastest decline any time. But between March 23rd and yesterday's close, it regained about 29%, which leaves the market about 15% below its all-time high. A nice improvement, but still quite a ways down. The chart you see on the screen is the S&P 500 since 1929, and that shows you what the market has been doing over that span of time. It obviously bounces up and down. The scale is what's called a log scale. Leaving aside the mathematics for a moment, what that means is the steeper the slope of the line, the faster it's going up or down. And you can see it's had lots of ups and downs. It's indicated by the red dots. And the red dots are chosen just by what the market's done. There's no great economic theory that tells you what a peak or a bottom is. It's just the numbers right there. So to give you a quick sense of things you probably remember from the recent, maybe 1987, one afternoon in October, actually one day in October, the market dropped 20% at one shot. That's the biggest one-day drop ever. It was obviously a little bit shocking when it happened. But what was sort of the pleasant ending to that story is that the market closed the year even where it started. If you put $1,000 in the stock market January 2nd, 1987, December 31st, you'd have that $1,000. No more, but no less. So sometimes it turns out nicely. Much more recently, in March of 2000, we discovered that technology stocks and the internet would not save the world. Only in the 1990s, we all thought they would. In fact, we thought internet companies didn't need to pay profits. In 2000, we discovered they didn't have profits. They didn't even have revenue, and we dropped. In fact, the market went down about 50%. And I'm sure just about everybody remembers the financial crisis, 2008, 2009. The market went down another 50% at that time. But we can take a longer look and get some sense of how things compare and so on if we'll switch to the next slide, please. The next slide. Let me continue. We'll pick up in the next slide when it shows up. What we're doing here is comparing different markets by seeing how, assuming they all start, all start at 100, and how far down they go. The bright yellow on the top left, that's 2020. You can see it goes down. In fact, it goes down faster, more steeply than anything else, but then it rebounds. And our real question is, what does this rebound tell us about prospects? Next to it is a very dark blue line that goes down pretty far and pretty fast as well. That's 1929. But 1929 and the Great Crash was really a two-part story. It went down in 1929, paused, rebounded somewhat, and then in the first half of 1930, it seriously went down. And if you follow the purplish reddish line that goes all the way across the screen to the lower right-hand corner, that's the 1932 crash, the big one. The big one was definitely the big one. Between the summer of 1929, when the economy was at a peak and the market was at a peak, and late 1932, it was down 85%. If you remember that $1,000 I said you get back in 1987, if you put that in the market in the summer of 1929, about 3 years later, you would have had 150 bucks. Not too exciting, to say the least. Moreover, it would have taken until 1954 to get your $1,000 back. It was definitely the big one, without a doubt. But looking at this, does this history tell us anything about where we are and how can we think to the future? Well, stock markets or bear markets tend to start at the top. That's almost a tautology. But let's think for a moment about how they get up to the top before they crumble. As the market begins to move up, investors look at the market and investors look at each other. Investing is not this somebody hidden away, not thinking about anything but a list of numbers. He or she is looking at the market, trying to figure out what everybody else is doing. And indeed, over time, as people gain some confidence, they get some feeling for the market, they decide to buy some stocks, they essentially buy in. And gradually you get a herd forming. And it is very much definitely a herd. And it forms, more people join, more people buy stock, the market moves up. And this herd begins to develop an image of what the economy looks like, what the market's going to do. If you think back to December, January, February, December last year, the very beginning of this year, before we got word about the virus, the market view was the economy looks good, the Fed was on our side, it had eased interest rates recently. The numbers seem very positive. The U.S. economy is rolling along. Corporate profits were expected to be quite good for 2020. Indeed, everybody felt good. We all shared this worldview. And then all of a sudden, we realized there was a pandemic. We saw the death counts climb. China, Italy, New York, other parts of the United States. We were told to stay home. And our entire worldview crumbled. Instead of a view of a great world with a growing economy, our view was four walls of an apartment. And the worldview changed and the market plunged. But then, among other things, the Federal Reserve poured money. The U.S. government announced we're going to spend $3 trillion, which by any measure is a pretty shocking amount of money, pretty large amount of money. And this herd began to slowly reform. And it's been reforming since March 23rd, right up now. It's got some bumps. The market is still volatile. Yesterday, it seemed to get very worried, mostly about Tony Fauci's comments to the Senate. Overnight, it seemed a little less worried, and so it's pretty much even at this point. But we're building a worldview, and the question going forward is, how well do we believe this? How far are we willing to stick with our worldview? What's really going to be happening? And tell you the truth, I don't know the answer. I don't think anybody else knows the answer, which is usually the case on Wall Street. But if we think for a moment, if the generally positive feeling that market seems to have had for the last month and a half holds, if as states reopen, which we've heard about in the newspaper, things look good, companies start up, people begin to go back to work, they're not afraid to get on the subways, they'll get together a group of more than 3 people, talking about going to theater, movies, all this kind of stuff. If that happens, the worldview is holding, it's proving to, and the market will continue to move up. It probably is not going to go straight up. There will be some bumps in the road. There's a lot of nervousness about how much companies earn, and what companies earn in the long term makes a big difference. But the other side of the story is really ask yourself, are you willing to go to the movies? Are you willing to go be one of 100,000 people at a football game next fall? Is the virus coming back? That's probably the key item. And it really depends on how this worldview unfolds as to where we are. I don't think anybody knows, as I mentioned, but that's the puzzle we're facing. And that puzzle will tell us whether this turns out to be like 1987, pretty scary when it happened on October 19th. I can tell you that from personal experience. But with a little sigh of relief when we got to the end of the year, 2.5 months later, and realized we were still there, and in fact, our stocks were still there. Or it could look like 1929, where there's a brief respite, and then it all falls apart or something like that. So that's the puzzle. You can see for all these colored lines here, it's done all kinds of things. The bear market in 2008 was pretty far down, 50%. But that's unusual. Since the Second World War, there have only been 3 cases where the market's lost as much as 50%. All the rest have been less severe than that one. Here's one more bit of history. If we go to the next and last slide for a moment, and look at that. And if you think back, like we've been talking really since 1929 going forward, but the stock market didn't start in 1929. In fact, the stock market goes back to the American Revolution in one form or another. But the Dow Jones Industrial Average, which on the last and third side, when you can see it, this shows you the market as measured by the Dow, which has a longer history than the S&P 500. The Dow actually started in 1896, but what I'm showing here is from 1914 until 1929. The reason I'm showing it is there's a bunch of little white dots that sort of cover the first green stripe there. There was an epidemic or pandemic in 1918, nicknamed the Spanish flu. It didn't start in Spain. It actually started in Kansas at an army base called Fort Riley in March of 1915. The day it started, the next day, they had 100 soldiers sick right away. And it continued spreading across the country in all different directions. There was a wave in the fall in San Francisco where they attempted to reopen the city too soon and unfortunately had a surge of deaths at the end. The last report that shows up in the United States was March of 1919. It lasted an entire year. You can see here it didn't phase the stock market too much. In fact, it looked like the guys in Wall Street didn't even notice it. They were much more concerned about the end of the First World War. They were concerned about a recession. There was a huge collapse in prices and a huge surge in prices and so on. Maybe the biggest difference was communications were a lot less in 1918 than they are now. Travel was a lot less in 1918 than they are now. So you didn't have this spreading going on quite as dramatically as it is in 2020. On the other hand, the 1918 flu was global. It hit virtually every country. The impact in the US was severe, but less severe than many other countries. So that's a little bit of ancient history. Maybe that gives us an extra hint about what the future looks like. But the future really depends, I think, on how we all react, people and businesses, as we attempt to reopen the economy, and unfortunately, how healthy we are and whether the coronavirus isn't quite over yet. So thank you, and happy to do some questions.
Thank you, David. That was very insightful. Thank you so much. We do have a number of questions that have come in. The first one is a relatively general question from Alan from Ottawa. And Alan asks, in 2025, when we look back on COVID-19, what will we say were its most globally significant impacts?
It's definitely the most general question, and maybe it needs an overly general answer. Part of this is maybe what I'd like to see, but I think we will see one change in the way we all think about our government, what our government should do. Because what happened very quickly in the last 3 months is everybody in Washington, or just about everybody in Washington, suddenly seemed to decide the government's really supposed to do something to help us. They're spending $3 trillion. The Federal Reserve is doing things that, in terms of supporting the markets, are unprecedented, even considering what they did back in 2008. So I think there's been a huge shift in the thinking there. Second of all, the whole question of what should we believe about science, how should we treat science, I think has been put front and center. Because we see scientists, especially epidemiologists, and clearly a few that are running on TV, we see them front and center, and we really see how they're thinking and how they come to their conclusions, how they try to understand what the world is going on. To some extent, you know, for those of us who haven't been in a university classroom for a long time, this is a great thrill. This is the kind of thing I think we all saw when we sat in graduate room classes and listened to the professor and then tried to did the thinking ourselves and the exploring ourselves and how to think about things. But we see people doing this front and center all the time. So I think maybe we have a better appreciation of that. More to the point, the U.S. economy will recover. The U.S. stock market will recover. I'm not going to guess where either one will be in 2025. But looking at all this, you've heard, is this a V-shaped recession, a U recession, every letter of the alphabet. Over the long haul, the economy grows gradually at about 2.5% the last 10, 15 years. We will go back to growing, but we will not get back to the old growth path. So if nothing had happened and we would have been at a level of, say, X in 5 years, we'll be growing in 5 years, but we're not going to be back to X. We're going to be probably X minus 3 or 4 percentage points. So we'll be on the same growth path, but we won't be as high as fast as we would have been. Thank you.
Thank you, David. A question about the chart. What are the background green bars on the chart that's up right now?
I guess I missed making that comment. Those show periods when the U.S. economy was in a recession, essentially when unemployment was going up, industrial activity and incomes were going down. There's a group called the National Bureau of Economic Research, which despite its name is not part of the government, that determines when recessions start and end. They do it with great care, which means they don't do it at the moment. So given their usual speed, I would guess comes September, October, November, there'll be a press release that says the recession started in the first quarter of 2020.
Thank you, David. Sorry, so there an additional question from Eric T. It sounds like you're framing the biggest question as, is the virus coming back? Regardless of what politicians are saying, epidemiologists are saying that it absolutely will come back. The only question is how big the surge is and geographically where it will happen. Given that, how does that impact how we should be looking at the market?
But clearly, I think the return of the, clearly, I think first the return of the virus is probably likely. I'm not an epidemiologist, but I've heard a lot of them say that. I guess I respect their opinion. A key item is how strongly does it come back and so on. But this, a possible countervailing thing, there's an article in the paper recently, I think in the Times, that said, what happens at the end of a pandemic? How does it end? And at some point, as the virus begins to fade away, because nobody said it turns off all of a sudden on a certain date, as it fades away, all of us are going to go back to being more normal. We're going to get back on subways. We're going to go to groups of more than 2 people at one spot. So we might stop wearing masks and that kind of thing. So part of it's how vicious is the virus when it comes back. But part of it is, how do we see it? Really, what do we see as our own personal risks and so on? If we're all deeply scared, we're not going to go outside our apartment, we're decided the virus is back and the economy will act like that. But if we decide to go out, decide to do things, even if there are still slightly more than the normal rate of deaths, the economy will pick up. So it's both the people and the disease that matter.
Thank you, David. Here is a question about more nitty-gritty predictions for the stock market. Clemens from Berlin has asked, given current stock market valuations as reflected in the Dow or S&P 500, would you consider stocks still overvalued, and are you expecting another drop to mid-March levels? And a similar question comes from Deborah from West Nyack. Do you see us testing the March 23rd bottom of the market?
Well, we'll take the first one first. That's probably the easier one. I actually went and looked at some estimates on earnings in the S&P 500. And just to give you sort of a sense of scale, in 2019, companies all together, the earnings number would be about $157 a share. And the forecast for 2020 is been dropped to 113, which is a pretty nasty drop. If we base the market on what we think 2020 earnings will be, it is richly valued at this point. It's a PE ratio of 25. And it's been higher, but not very often. So I think it is a little bit overvalued now. If you believe we're all coming back in 2021, the earnings will be better than they were last year. And so I think if the market hangs on for a while, doesn't get spooked over the next few months, it will begin to look at the 2021 earnings. And if the estimate I saw from analysts of $164 is anything close, we ought to make it. But just about anything can spook it, in which case it would go back down, and so on. If I had to guess at this point, we probably won't go much below the lows we saw at the end of March. Because we've got some cushion in between there, and unless we decide that is really, really a vicious return of the virus and everything shuts down, we'll probably sort of muddle through for a while. But I should add, first, there's no guarantee in that, and second of all, market's very good at fooling all of us, and certainly me from long experience. Next.
That's great. Thank you. The next two are verging on investment advice, but so I just want to reiterate the note that I made earlier. So Rivka from New York City is asking, what should we do with stocks that we own? And Victor from New York is asking, what would you deem optimal trades and sector balances for diversified stock holdings in retirement accounts with 3 to 7 year time horizon?
All right. What should we do with the stocks we currently hold? Well, the silly comment is probably worry about it, and I'll admit to having been doing that somewhat too. I think the kind of comment you hear, and I think there's some validity and so on, is to look for the long haul. Part of it's deciding what your long haul is, and you know, if you're 25 years old and you've got 40 years of working life ahead of you at least, and there's plenty of time to recover, I'd probably hang on. And there have been ups and downs. You saw that in the first chart. There'll continue to be ups and downs, but so on. But I think to address the second question more, where he's suggesting a 3 to 7 year time horizon, that's quite different. This sort of received wisdom, which you should always doubt probably, is known a mix of stocks and bonds. And the old advice used to be the proportion of bonds in your portfolio should be equal to your age. So if you're 70% should be bonds. I think the advice is very old, but more to the point, bonds are at a very strange juncture. The interest rates, first of all, they're near zero in some cases, but second of all, they're the lowest they've been at least since 1980, but you almost say modern history has 50 years. Interest rates have been going down for 50 years. If they're going to go anywhere, they're going to go up. And when interest rates go up, bond prices go down. So I'd be a little bit tempered with that. The last thing I'd say is that I spent a long time working with the S&P 500 and a lot of stock indices and investment products built on them, which gives you fantastic diversification. And the old saying is don't put all your eggs in one basket. And I think that's really true. Over time, people who just put their money in a big, broad, diversified fund like the S&P 500 probably went home happier than the ones who thought they knew the best stock or the best 2 stocks, the best 10 stocks, or the best 5 stocks or something like that. But that's not advice. And, as Aaron said, you really should talk to a financial planner who is in a position to give you some advice and answer your questions on a one-to-one level.
Thank you, David. A similar follow-on question is when, or I suppose if, are we going to start a bear market for U.S. government bonds?
But U.S. government bonds are very special in the sense they are backed by the U.S. government. They're also special in the sense that just about any place in the world, they are considered the most credit secure, most rock solid investment possible. Maybe British government bonds or Japanese government bonds are at that level, but probably not. So if we're worried about U.S. government bonds and a bear market where the price of the bonds would plunge, there are 2 things that could happen. The first, as I suggested, is interest rates could go up. Because if interest rates go up, the value of your bonds would go down. If you bought a 10-year treasury and it was paying you a coupon of 2%, so on $1,000 treasury, you'd be getting $20. If the price goes down, you'll still get your $20. That's because the treasury is not going broke, neither is the U.S. government. But if the interest rates go up, so a new bond would be paying you 4 or 5%, the price of your bond's going down. And if you went to sell it, you have a problem. Over the next year, 2 years, certainly over the recession that's beginning now, however long it is, I don't see interest rates going up very much, and I don't think U.S. government bonds are going to move very much. Farther than that, interest rates will recover and go up at some point, and when that happens, the value of the price of the bonds will go down. As to the full faith and credit of the U.S. government going broke, no, I don't think that'll happen. First of all, I'm an American citizen. Second of all, it's my honest opinion. And And if the U.S. government goes broke or stops paying interest and principal on its debt, we got a lot bigger problems than anything we've seen in the last 6 weeks.
Thank you. This looks like this may be the last question for you, although it's a few questions embedded together. This is from Michael from Pleasanton, California. What are the indicators that distinguish between a V versus a W recovery? It seems that we are heading toward a W, especially if we open up too soon. Can the market sustain an extended quarantine, say of another year or so? And states can't go bankrupt, but look at what is happening to cities and towns. Are municipal bonds threatened?
Well, actually, I think states can go bankrupt as well. I'm not a municipal bond analyst, and nor am I a specialist or lawyer for state laws. But I think in theory they could go bankrupt and so on. It would look somewhat similar to cities and towns. It would be pretty messy. At some point, you know, we talked about the market being driven by herd opinions and that kind of thing. A herd can carry the market up or down for quite some time, but at some point, the herd has to deal with what's going on in reality, in the real world. So if the virus came back pretty viciously, as you suggested, and the lockdowns in the economy was going to extend, you know, into a year or more, the stock market won't ignore that. Neither will any of us on this call and discussion ignore it, probably. So at that point, the market would clearly be going down. We could wave goodbye with March 23rd numbers as we sail past, and we'd be thinking about that 1929, 1932 kind of gambit and that kind of thing. I mean, you know, and in that kind of environment, the recovery would be very difficult. The W theory is you come down, you bounce up, and you go back down. And a lot of people have been hesitant that either the return of the virus or opening up too soon would immediately get us a W, and so on. What would I be watching? I would be watching trends in employment, not so much the unemployment number, but the changes in the number of people employed and the weekly numbers of people filing initial unemployment claims, which come out on Thursday morning. The last one is probably the fastest to respond economic indicator of anything the government publishes, and so on. But my suspicion is, just listening to the news, that if the virus is somewhat controlled some places, we're going to see a lot of places being encouraged to open up and forced to open up, given the kind of political noise that I'm hearing, and so on. There are people out there determined to reopen the U.S. economy, even if you convince them it's going to cost some lives. And that's a difficult thing to say, but there seem to be people like that. Next, or?
Thank you, David. I don't think we have. Hi, everyone. I don't think we have any further questions. I want to thank David Blitzer for all of his insights today. Thank you, David. What a wonderful way to kick off this new GSAS conversation series. We very much appreciate all the time that you spent with us. I want to also thank our alumni. Go ahead, David, sorry.
I said I'm pleased to do this, and I'm looking forward to next week's.
Thank you. I encourage you to join us again next Wednesday at noon Eastern Standard Time. We're going to welcome Jessamine Conrad, who is a 2016 PhD in art history and archaeology. She will speak to us about how the Black Death led to the little black dress. Subsequent presenters include Martha Joint Kumar, who's the director of the White House Transition Project. She's going to speak to us on current presidential press relations and upcoming transitions. And one additional presenter that we have will be Gerard Bushell, who is the executive chair of the new terminal development project at JFK International Airport, And he will speak about, among other things, the impact of the pandemic on air travel and the airport of the future. And please send me suggestions as to anything else that you would like to hear about. As you know, the GSAS alumni body is very large and has many varied interests and expertise. And we look forward to welcoming many more alumni to follow David. Thank you again, David, and to everyone, be well and stay well, and goodbye.